Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking at the topic of market momentum. So just before we begin, if we can just draw your attention to our disclaimer, please do take note of our disclaimer currently up on screen, and just always be aware of the risks involved in trading the financial markets. Okay, so just to cover a webinar outline, so we'll start by introducing momentum to you and just explain to you exactly what it is. We'll have a look at the economics behind momentum as well. And if you're trading financial markets and you can get into trades with momentum, you're very likely to improve your chances of becoming consistently profitable. So with that in mind, we'll have a look at the trading objective, exactly what the objective behind trading is to do. We'll have a look at the causes of momentum as well. What actually structurally causes the markets to move with significant momentum. So we'll break down those market movers in some detail for you. Then we'll have a look at the combination of momentum, direction, and trend in just a little bit more detail, because they work hand in hand. And if you can get the momentum, you get the direction right, and you can trade within a trend, you really do give yourselves fantastic opportunities to be consistently profitable. And we'll also look at the impact that news releases can have on momentum as well. And what we'll do is we'll finish by looking at the practical side of momentum and how we see it and how it manifests itself on a trading chart. So that's a webinar outline. So let's start with just introducing you to momentum. And to give you a definition, market momentum refers to the velocity in a particular market. So it is the market moving, is the market moving decisively in a particular direction? That is a question we do need to ask ourselves, because if so, then what you will see and experience is that momentum is rising. So what we're talking about is the rate of change is either increasing to the upside or potentially increasing to the downside, depending on which direction momentum is moving in. So, so when we look at direction, momentum, and trend, these are all very much key ingredients with which price movement is explained and analyzed by technical traders. So they're often looking to identify which way the market is moving in. Can we physically see the momentum in the markets? And if so, there's the likelihood is we could be trading within a trend. And these are all things that are very, very important to technical traders. So together they are perhaps the most effective measurement of where the market is likely to move to next. So that's why these things are crucially important. Now, a market bubble or a market collapse, for example, represents an extreme shift in price, which reflects an extreme adjustment in momentum, direction, and trend. So that must always be, it's actually quite important to be aware of these things. And we're talking about major market events as well. So in fact, like a market, for example, some of the cryptocurrency markets over the last, let's say 10 to 12 months, for those of you that are aware of markets like Bitcoin, it's actually experienced the market bubble and a relative market collapse in a fairly short period of time. So these are obviously very, very extreme events. And they, without doubt, they reflect an adjustment in the actual momentum. So for the first, or should I say, for the latter part of 2017, for example, a market like Bitcoin saw incredible momentum to the upside and direction, and traded very firmly within a trend. And then in the earlier parts of 2018, we saw the reverse of that, where momentum shifted, changed, moved to the downside, which is the direction in which that market was then moving in. And then we saw a trend to the downside as a result. So that just shows you that these markets can boom and bust actually relatively quickly in a short period of time. But it's very much in a trader's interest to understand what direction the markets are moving in, how much momentum is in these markets, and of course identifying whether a trend exists in those markets as well. Okay, so moving on then, let's have a look at the economics of momentum. So if an economy grows, it can be crudely measured by its increase in what's called gross domestic product. So this is the market value of all goods and services produced over a particular period of time. So what this will mean in the direction of the underlying equity index, for example, is that the market will be relatively bullish in nature. So if we see that an economy is growing, if its GDP is increasing, then it's likely to have a very, very positive impact on that jurisdiction's equity index. Now, in contrast to this, if the underlying supply and demand function of a commodity, for example, this time drastically leads to long-term price declines, meaning the directional movement in price will be expressed through, and you can see it visually in the momentum of that market, the direction, and also the trend. Now, the trader should therefore be looking to maintain a preference to trade this commodity to the downside. And this is really kind of a more of a practical approach to trading. So in layman's terms, we will want effectively to buy a market that is strong because momentum is driving prices in that direction. And of course, alternatively, we will want to short a market that is ultimately weak because the price action takes that direction of momentum to the downside. So basically, if a trader can identify momentum to trade in a particular direction, it can then give the trader a great chance to become a profitable trader. And that's really the economics, and we'll discuss it again just in a little bit more detail very shortly, but that's the basic principle that a trader should look to adopt. So to just highlight the trading objective, and to sum up this, in simple, it therefore makes sense for a trader to trade with the prevailing momentum as much as possible, because a trader can achieve better results if we trade what's called with the market. So that's the major distinction, and there is lots of traders out there that trade against momentum. They try to sell the highs, sell the highs of markets, and they look to buy the lows. And without a shadow of a doubt, it often makes more sense to traders to actually trade with the market rather than trying to trade against it. It can become quite a frustrating environment. Okay, so that is ultimately the trading objective, really, is to trade with the prevailing momentum and really look to trade with that market. So what are the causes of momentum? And who is participating in these markets to create the momentum that we see on a trading chart? Well, the first one is your speculation, those that speculate on price moves. So, of course, during times of illiquidity, speculators can come in and make a series of trading decisions that can have an impact on the momentum of a particular market. But the chances of that happening, as you will see now, are very, very small, because another cause of momentum is market sentiment. And that's whether a market has a particularly good feel. If there is a strong positive momentum about a particular market, then you're likely to see prices move to the upside. Now, a good example of that just fairly recently is the strength we've seen come back into the US dollar after nearly a year and 4 months of declines. So the market sentiment behind that move is really quite positive, and as a result, we are able to see that correlating momentum as a result. Now, increasing the size and the potential for increased momentum is also those that look to trade on and trade off, risk on and risk off. Now, if we take a risk on approach, it means that there is a likelihood for the global equity markets to be moving to the upside. So traders and are quite prepared to take on more risk and trade more riskier assets like your stocks and your equities and your global indice markets. And as a result, they are adopting a risk-on approach. But also the opposite applies, which is those traders that look to trade risk-off. And that's when there's not so much confidence in the equity space and the global indice markets. So traders look to trade other markets in situations like that, and it's also referred to as the flight to safety. So you might see momentum coming into the yen, for example, or even into the gold markets, depending on what's happening, certainly on a geopolitical basis. So the whole principle behind risk on and risk off can very much cause additional momentum in different markets for different reasons. So too, of course, is our institutional investment and trading entities. So, of course, these are your hedge funds and probably your banking sector effectively. And it's those institutions that invest in these markets and that trade the price action of these markets, and they'll be looking for major moves off news events and things like that, and making sure that they get the fundamentals behind their trades correct. So they're obviously responsible for a large portion of momentum in whatever markets they determine are best to trade. So it's a huge source of momentum in these markets, largely because the amount of capital they have access to. You talk about your insurance industry and everything like that. So the often overlooked causes of momentum are certainly the elephants in the room. Perhaps traders don't give these entities enough credence in terms of their potential power to drive markets and to push momentum in certain directions. And that is without a doubt our central banks. They're also your global investment entities and your global hedge funds as well. So they have access to vast amounts of capital. Some of your global hedge funds are in their tens of billions. So of course they have the potential to cause momentum, and they do so at an incredible rate. So if you can just identify with the speculation, and this would encompass many of us in terms of retail-based traders. So we're responsible for a relatively small portion of momentum direction and the potential to trade those trends. Whereas if you look at the other end of the scale, would be your central banks that can print money, can provide the markets with quantitative easing, and can basically just facilitate major market momentum. So those are the entities that engage with these financial markets and effectively cause momentum. But let's look at, in a little bit more detail, some of the market movers, and within that spectrum of the causes of momentum, you have individual topics or individual aspects that can very, very much move markets and provide incredible momentum either to the upside or to the downside. And just touching upon, just starting from the top left-hand corner, of course, government elections have huge impact on the performance of a particular economy, whether their political stance is conservative or liberal or labor orientated. It has certain implications for that particular economy with regards to income and expenditure, and of course that has the potential to drive business in a positive way or a negative way, depending on some of the decisions that are made. And of course, the government that is elected to represent its people in whatever jurisdiction that may be, can therefore impact markets and provide momentum in those markets. In addition, we have OPEC, and a good example is the current OPEC deal, which is in place to restrict the supply of oil on a global basis in order to drive the prices to the upside. So we're currently, and we have been for quite a while, seeing some serious market movers in the price of oil, and we're seeing incredible momentum drive prices to the upside as a result of this organization and the decisions that they've made. Government policy in line with sort of the elections as well. You know, the specific decisions that are made with regards to perhaps its deficit or surplus and the implications that can have for its economy and business and GDP and things like that are all very, very important factors that can move markets and add momentum either to the upside or to the downside, depending on the performance of that the government and that particular economy. Political referendum are a little bit more isolated instances which can be incredible market movers and provide incredible momentum. And a good example would be the Brexit referendum, where the UK decided to have a vote to leave the European Union, and that was the actual outcome. So we're still the UK is still dealing with those consequences now in terms of negotiations, but it was a political referendum. We saw a major devaluation in the British pound as a result, and it was a major market mover and provided incredible momentum to the downside. Also currency valuation as well. You know, if a currency is particularly cheap, it can have some considerable impact on that country's exports, because they'll be cheaper to purchase. So you're likely to see, if the currency is devalued, you're likely to see an increase in purchases from that country, and that can impact everything accordingly as well. Economic figures and the release of economic figures are very, very important. They're market movers. We'll have a look at an example very, very shortly. And of course, they can also provide considerable momentum either to the upside if those economic figures are good, or also to the downside. Things like war. Of course, if a country goes to war, it needs to commit X amount of its GDP perhaps to that cause, which can cause a lot of turmoil, obviously a lot of misery as well, and the consequences of war can really impact its equity markets, the value of its currency. So there's lots of downside to war. Of course there is. Also default, as we know, there was a number of European countries during the European crisis that were close to default, Greece being one of them. And as a result, had huge impact even on the euro, was a major market mover. The instability in itself on a global level was felt by everyone, certainly people in the European Union, and provided incredible momentum to certain markets. And then things like your central banks, of course, the decisions that they make, whether it's regard to reducing interest rates or increasing interest rates, which is more of a theme that we're dealing with currently in these financial markets, but also to do with quantitative easing and decisions made with regards to asset purchases and things like that, can be huge market movers and can provide incredible momentum in a whole host of different markets. Commodity forecasts, of course, impacting the commodity markets. If there's a perceived supply issue in a particular commodity, then of course, and that commodity is in high demand, of course, that's likely to impact the price, provide more momentum, and be a major market mover. Also, things like a market collapse. If we're seeing a market fall from its high in a relatively short period of time, it can provide some fantastic trading opportunities. Obviously, it has some more medium and longer term concerns and issues as a result of a market collapse. It's not really what we want to see. It does provide traders with some fantastic market movers and incredible momentum as well. And just to highlight and separate the US Federal Reserve from many other global banks, central banks, should I say, and that purely, the reason for that is just purely down to the influence, the global influence of the Fed in the US, and decisions that are made by the largest economy in the world are quite profound, and they can have major implications for global markets as a result. Okay, so that's just a little review of market movers and momentum. So just to conclude then, when we talk about momentum, direction, and trend, these characteristics are the basis on which price action moves and from which the technical trader derives its analysis. So they are together the most effective measurements to indicate where the market is likely to move towards as well. So to emphasize momentum, think of, for example, the recent market bubble like Bitcoin, like I've alluded to. Then think of an equity market collapse, perhaps like the collapse we saw in 2008 during the financial crisis and the credit crunch. Now, these two examples epitomize how market momentum can cause drastic price change. So as a result, momentum and direction are the basis of trend formations. So without a market moving in a certain direction and without the momentum behind that particular move in whatever direction we're talking about, then we won't see the formation of trends. So that's why these three items work hand in hand, and they are the trader's initial basis to for technical decision making. So that must be understood effectively. So as an economy grows, it can be numerically measured by its increase in gross domestic product. This can mean the underlying markets within the region is likely to form a relative bullish move to reflect this progress which is made in GDP. Likewise, just to give you a final example, if the underlying supply and demand function of a commodity drastically leads to long-term price declines, logic will be expressed in the momentum of that market and the direction in which that market is moving, and then we're likely to see the formation of a trend. So as traders, we will want to buy markets that are strong because of the momentum, direction, and trend that we may be seeing in our favor. Alternatively, we will, as traders, be looking to short a particular market that is weak because the price action takes that particular direction and has momentum behind it. So it is perhaps obvious to say that a trader will see better results if they trade logically, and that's really the point we're making. However, it is in our vast experience that the majority of retail traders do not necessarily incorporate or follow a logical understanding of momentum, direction, and trend in their trading. And therein lies some of the difficulties which many individual traders experience, certainly on the retail side. And what's very, very apt is the phrase, the trend is your friend. I'm sure it's something you've heard quite a lot, and it really is your friend, because trading against the trend is like standing in front of a fast-moving train with the hope that you would expect and hope that that train would stop before it hits you. So that's the metaphorical analogy, effectively, of trading a market with the momentum against the momentum. So it's not really advisable. It's not ultimately a logical position to take, although there is some profitable traders that can work within that environment. But without a doubt, if you embrace the concept of the trend as your friend and just know that the importance that direction and momentum can have in that role will put you in a really strong position to be consistently profitable. Okay, so just to finish off then, we want to just touch upon momentum and news releases. So these are specific news events and they are one of the most explosive events that a trader will experience on a daily basis. And this is the news, this is the release of a major news event. So economic news releases often drive strong moves in a particular market where we'll see momentum moving to the upside and to the downside. Traders can look for trading opportunities upon the release of a major market moving news event. And that's something, it's called trading the news. It's something that some traders like to focus on. Now it does come with its, I'll show you very shortly how it comes with its certain caveats to adopting that kind of approach. But effectively, it's useful to know that a market acts as a discounting mechanism. And what this means is all available information is considered, taking into account both the present events that impact that market, but also the future events. And all of this information is contained in its price. So the reason why that's so important is because when unexpected developments occur in a particular market, we often see momentum build and prices as a result move very, very quickly indeed. So let's give you a practical example and let's just show you what that looks like in real terms. So this is looking at momentum in practice. So I'm going to play this video for you, and what we're seeing up here is Forex Factory, and we're just going to highlight a news event at 12 p.m. So we're going to highlight the official bank rate, the asset purchase facility, and also the votes as well. So taking a note of this news event, and let's see what happens when these figures were released. So, and this is the reality. This is momentum in practice, and you can see the build up to this news event. Prices are already being built in, and it's expecting a negative news release, and that is and it must be pointed out that this is the euro pound. So what we're seeing is actually a positive news release for the British pound. It was a British pound news event, and we are seeing prices move to the downside against the euro. And a better example is this 1 minute chart in the pound dollar, and you can see the explosive move now in the pound dollar, where you're getting that explosive move to the upside. And to just show you the different examples of different types of momentum that you can experience, and looking at the UK 100 or the FTSE, you can see that the volatility wasn't quite as forceful as we saw in the euro pound and the pound dollar markets. So the point we're making with that is basically around the idea that you can experience a news event in a particular market, and you have to be careful about how it impacts those particular markets, because not all related markets are necessarily going to move. So we saw the pound, in terms of the currency, move with incredible momentum and clearly identified direction. But as we saw with the FTSE 100, it wasn't quite the same. Okay, so that just about concludes this particular webinar about market momentum. So we've looked at a whole range of different topics, introducing momentum, looked at the economics behind momentum, what is the trading objective for traders. We looked at what causes momentum and those market movers specifically. Then we looked at the combination of momentum, direction, and trend, and then finishing off with how news events can impact momentum. And then we had a quick look at that very, very short video. Okay, so all that's left for me to do now is to obviously thank you very much for joining us. Do take care, and we do look forward to seeing you next time. So from everyone here, bye for now.